Hello, welcome to Diamond's Edge Live. My name is Greg Diamond, and we're switching things up a little bit this week. And one of the things that I want to do in this show is, yes, every week I'm going to have things that are happening in the market, what I'm looking at, short-term setups, long-term setups, time cycles, time factors to watch. But I also want it to be educational for those who might be just starting out. Okay, so from time to time, I'll have these recordings where we'll go over just some of the basics and we'll look at different elements of technical analysis. Now, one of the things that I like to explain to people, and you're going to find this throughout your career, or if this isn't your career, throughout your investing, lifetime, that there are certain things within technical analysis that people like to criticize, which is totally fine. But what I think people need to understand, investors, whether you looked at technical analysis or not, is what it is telling you. And what technical analysis is telling you is human emotion, human action, buying and selling, human fear and greed expressed on a chart. That's what technical analysis does, okay? It's both an art and a science, okay? There's math involved. There's also an art of understanding what do these patterns mean, okay? But when you see these patterns repeat time and time and time and time again, it's hard to ignore them. In fact, you don't ignore them, you manage your risk around them. And so to me, that's one of the, probably the most important part about technical analysis, how it should be used, and how it should be thought of as another tool in your toolbox, okay? Some people like to criticize technical analysis, but they've actually never used it, okay? Some people just like to stay on the sidelines and say, well, I don't understand it, therefore I'm going to criticize it. I think they're not having an open mind about what is possible. As W.D. Gann famously said, there's nothing new under the sun, okay? History repeats, human emotion repeats. It doesn't always repeat day after day or week after week, but there are these cycles, there are these patterns within a market, within greed, within fear that we see all the time that just constantly repeat. And then, putting a method to the madness is the technical analysis behind it that helps us manage our risk. Okay, so I just wanted to start there. I think that's a very important concept to grasp and understand. Next, there are many ways to skin a cat when it comes to technical analysis. There are folks out there who will say Elliott Wave is no good, and you need to use what I call classic technical analysis or classic pattern recognition, and that's fine. I think what you'll also find is as you go through this process, you're going to find what style fits your temperament, fits your risk profile, fits how you like to view the market, how you look at it, more short-term, more long-term. That's something that will take time to develop. For me, I have what I call the 3 tenets of technical analysis that I personally use. That is Elliott Wave, which is price. That is time analysis, which is based on W.D. Gann's work. And then the indicators is the third thing that complement those first two. Other people don't like Elliott Wave, and they'll stick to, again, the classic technical analysis. Head and shoulders, inverse head and shoulders, flags, pennants, consolidation patterns. These, to me, tend to take a little bit longer in time. Okay, you're looking at a more longer time frame than some of the shorter moves that you'll see with Elliott Wave. I'm not saying one is better than the other. Again, what I just mentioned, for me personally, I tend to gravitate towards Elliott Wave and Gann and time analysis with, again, the indicators, complementing that. But you'll figure it out. Now, the good news is, even within, let's say you just like the classic technical analysis, chart recognition, you can use various combinations of that. You can use Elliott Wave along with this, okay? So I've covered a lot there in terms of just kind of a general overview, but, I'm going to have these recording sessions every now and then, in a lull, a holiday week, whatever it might be. Sometimes in the summer things get slow, or people taking vacation, whatever it might be. So I just want to start with different groups, different topics, okay? And we'll cover them each week. You can go back, you can look at it again, jot some notes down, whatever it might be. So this week, what I'm going to start with are a few things. I'm going to start with very simple trend line analysis, okay? And when Then we'll go to Fibonacci retracements. So understanding support, how to measure it, what to look for. Okay. And then we'll look at some pattern recognition. I'll get into some of the classic pattern recognition, at least this time, and we'll look at head and shoulders and inverse head and shoulders. So what we are starting with now is just classic, simple, technical analysis based upon trend lines. Okay, so this is the S&P on a weekly chart. All right, now let me delete this. So let's say you're coming off the lows here in 2023. All right. So we have this low here in October of 2022, all right, and then we rallied, okay? And you're saying, yeah, so again, sometimes this takes a long time. You can see here that I drew this line. Let me redo it. All right, so I took this extreme low and I connected it to that low back in October of 2023, all right? And I'll highlight this here. Now, all this is doing, and this is just simple stuff, but all this is doing is connecting one low to another. And we've had, you can even say, you know, this is a low as well in March of 2023. Now, what I find fascinating about this is how the angles or the slope of a trend will oftentimes be the same. What do I mean by that? Watch this. So I'm just going to copy this, okay? So you can see I just copy this. I'm just making the same exact trend. Now, instead of going to this extreme low right here, I'm just going to where the market actually made, where it closed. Now, look at how crazy that is. So from here, look at what happened. This is on the same trajectory, the same slope, okay? And it nailed this low in March, all right? And as you can see, this held the low and then we rallied, all right? So when we extend this, look at what happened. Now we're moving out into, you know, a couple years later, and look at all of the support levels that held from this 2022 low, 2023, and then we zoom in here and you can see how, yeah, it traded a bit below this trend line, but overall, this was a point in the market where that the stock market respected this support level, okay? And that's what's important. Now, does it mean that you're going to get every single low, every single, you know, down to the bottom? No, that's not the point. There's a saying in trading, don't be a prick for a tick. Meaning, look, if we have, you know, this drop into this, it's around that level. We know, at least, you know, with a high degree of probability that we're going to see, you know, buyer step in. Oops, excuse me. We're going to see buyer step in based upon this trend line support. And it's simple trend line support. But clearly it worked, okay? And now we've taken off. All right. So that's just, you know, simple connecting lows, trend line support, a good foundation to start from, okay? Where is support? Are we in an uptrend? Clearly we are. All right. Now let's look at Fibonacci retracement levels, okay? You can look in extensions. I like to look at retracements within an uptrend to find support, okay? So how does that work? Now, almost every technical platform out there is going to have Fibonacci retracements. If they don't, just simply call up your broker or, you know, chat them on the platform and just have them add it. I can't imagine why they wouldn't have it, but if they do, if they don't, I'm sure they'll be able to add it for you. All right. So we can go through here. All right. Now, similar to what I like to do with trendline analysis, I don't just, yes, I take the extreme low or the extreme high and measure from that, but I also like to measure from, and I'll go back to this instant, okay? You can see there's 3 bars, and this is a weekly chart, but all right, they all around the same level, okay? And that tells me that there are significant buyers. That was an important inflection point that the market respected, okay? Same thing with Fibonacci retracement levels. So we can go in here, we can get our Fibonacci retracement level, all right? Now, this was something that I was measuring, you know, back in early April when we had all this crazy stuff going on with the tariffs, all right? So what I did was I took this extreme back in February and measured down to this extreme back in 2023. Look what happened. Let me highlight this for you. We got the 61.8% Fibonacci retracement level. Now, again, Did it bottom ticket? No, but let's not be a prick for a tick. It was right there at the lows, okay? And we had a couple options trades, Caterpillar and AMD, if I recall correctly, that we traded based on this low, okay? Now that's the extreme. You can go back and say, all right, well, this was the let's look at where the market had respected a certain level, okay? We can go all the way back here to 2022, okay? Look at what this did. Can you see that? So I went from this level up top, okay, to the near the extreme low, back in 22 at this low, and look what happened. Let me highlight this for you. This blue line right here, you can see here, that is the exact 50% retracement. And I'll zoom in. Look, right here, nailed the low, 48.35 on the S&P. The Fibonacci retracement level, 48.37. I mean, that's about as close as you're going to get. Okay, so now let's look at this. This was a confluence zone because we had two different measurements. One from this higher low, one from this extreme low, and then one from the extreme high to this. But you can see how this 61.8 and 50% retracement nailed the low. I mean, again, not perfect. I'm not looking for perfection. I'm looking, is this a high probability setup, okay, that likely tells us that we have support? Obviously it did. Okay? And then the market traded with, slightly down into a panic into it, slightly broke below the trend line support, and then broke out. Now look what happened after the breakout. Look what happened here. And this was April 21st into 22nd, which created this higher low. And you can see how it bounced off of this support level, which was the trend line, and now we're rallying. Okay. So when you're looking at Fibonacci retracement levels, let's do another one. All right. Let's delete this. Let's delete this trend line. All right. Now let's look at the low from 2020, okay, the COVID, up into the 2022 high. And then we had this bear market for the majority of 2022. And let's do the same thing. Let's take the extreme high to the extreme low. Look, you can see how this nailed the 50% retracement. Again, similar to what we just outlined. Different time in the market, same pattern, okay? 50% retracement, boom, right? We can see a similar, let's take the lower high from April 2022 to the low. Let's do the secondary, the higher low in April of 2020. Same thing, 50% retracement. So, you can see how these things start to add up. We can even do another one. Let's do the extreme high down to the presidential election in 2020. We got another Fibonacci retracement in the 76.4. So this is a great example of the Fibonacci confluence zones, how to measure them from different angles, or different levels rather, excuse me. Okay, and that's something that I think is important to understand, as a part, whether you like Elliott Wave or you like the classic patterns that I'll outline next. This is an important thing to determine where support is going to fall, especially on these weekly charts when we have these big moves. I tend to really like to look at those Fibonacci retracements after we've had, I look at them all the time, let's be honest, but especially after we have a huge round of volatility, okay? That's something that I really like to look at. We can look at, let's do the COVID crash, okay? So from the very high in COVID, let's go back to 2016, all right? And let's do the gap down, okay, into the low. And you can kind of see here, it wasn't perfect again, but we had this Fibonacci retracement level that marked support. We can go all the way back to the low in 2011, okay? And you can see here, once again, that was the low in 2011. That was the European sovereign debt crisis. And what do we have? Okay, we had the 50% retracement from this entire move, right? So, a 9-year rally, it dropped 50%, boom, off we go. So you can see how, these Fibonacci retracement levels can really work, okay? Again, sometimes it takes longer. But when we have these big moves, especially on a weekly or monthly chart, I really like to look at them in terms of, all right, where the support is going to be. And another great thing about technical analysis, and this goes to Fibonacci, this goes to Elliott Wave, this goes to, the chart pattern recognition. It can be used on any time frame. That's really key. You want to look at it a 1 minute, go for it. You want to look at it 1 year, have at it. A 1 week, a 1 month, all of these things can be used interchangeably. And that's what makes it so special, in my opinion. All right. Finally, for this week, let's look at head and shoulders patterns. And essentially, this is a longer pattern that recognizes either a major high or a major low. All right. First, I'm going to look at the head and shoulders top. Okay. And this is pretty simple. Again, it takes time. So this one developed February of 2011 into July of 2011. Okay. So several months. Okay. But the principle is the same. Okay. We have this head, which is the top, and then two shoulders. All right. Again, it takes time to develop. So you can see here, I've labeled it head, left shoulder, right shoulder, and then there's the neckline. When you have a head and shoulders pattern and the neckline breaks, that usually leads to a big break. And then here you can see, okay, back in 2011, we had the European debt crisis, okay? And once we broke below this neckline, and you could even measure it here too, because with this big spike, but it didn't really matter because the head and shoulders pattern worked, all right? You can see this drop, into October, okay? Now, how do you trade this head and shoulders pattern? This is where classic technical analysis, as I mentioned at the start, takes a little longer, okay, to trade, and then your risk might be a little bit greater. So let's say that, you're here. Let me zoom out here. Let's say you're here, okay? You don't know. You're like, okay, I'm analyzing this chart, and I see that this could possibly be, we have this shoulder, the head, we had a new high, we had this big dip, and now we have this possible right shoulder. How does this work in terms of a trade? That's the most important thing, obviously, right? Well, what you would do is you would take a short position here. Let's say this is S&P 500, let's say 1350. And what you would do is you would place your stop up here at, what is that? That is 1370. Okay. So simple trade. Okay. Again, you might have a lot of risk here, but so essentially what I mean by your stop is, look, if you analyze that this is the left shoulder, this is the head, this is the right shoulder, and it breaks above 1370, you're wrong. Okay. It's something else. You got to admit when the market tells you that you're wrong, the pattern is wrong, the analysis is wrong, and you got to, start fresh. Look for something else, okay? If not, go bullish, okay? But if you were right, you could see that you made a lot of money on this short position, especially when, this pattern was confirmed with a break of the neckline, okay? Simple as that. All right, now let's look at an inverse head and shoulders, and it should be its exact opposite, okay? These tend to happen at major lows. They can happen at highs. It doesn't happen all that often. I think we had one that happened in 2020, late 2024. Again, it doesn't happen all that often, but the big ones tend to be at major lows. And you can see this is right. This is into the end of the great financial crisis. And similar to what I outlined with the topping head and shoulders, is the bottoming or inverse head and shoulders. We have the left shoulder. We had the low into March where we had the big bailout. Okay. And this is your right shoulder. And this is, some people like to get very, very specific. Oh, the shoulders have to be exactly equal. No, they don't. Okay. It's okay if you have this, especially in a bullish setup, if this is a higher shoulder. All right. Now look at what happened with the neckline. Once the neckline broke, we never got below this low ever again. It just kept going. Okay. It wasn't without volatility, but this was a great trade back then, just based on this head and shoulders pattern. Now, how do you trade it? Opposite of what you would do with a topping head and shoulders. Okay, if you recognize that this was head and shoulders, inverse head and shoulders, you would buy. It breaks above the neckline, and you're good. Okay, if it breaks below this low, you got to stop out. That's the end of it. All right. So I don't want to cover too much in every episode, every recording, but this is a general start in terms of We looked at trend line, Fibonacci retracements, and then, we're getting started into pattern recognition. Next time I will look at some consolidation patterns, continuation patterns, reversal patterns, candlestick patterns. So there's a lot to cover. So stay tuned for more of those. Thank you very much.